Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're going to go over some commodity information from Twitter. I don't really have too much, other stuff to really talk about. So we'll go over that and see what's going on today. I'm doing this kind of real time since I've got the day off from my normal job. So let's dive in. If you want to follow me on Twitter, it's at finding_finance. If you want to follow me on there. But let's go through it. We've got German electricity market is broken by Doomberg. This thing is going vertical. And the German pricing, I don't know why it's not loading, but it is just going vertical. It is broken. And I don't know how companies are going to survive electricity prices at that price. It's very expensive. The backtest for this inflation index looks pretty interesting. And it's a volatile backtest, so it could be gathering energy. This is the Pring inflation trade. I used to watch Martin Pring back in the day. We've got a support line. It's basically projected upward. We've broken to the upside, and we're doing that retest. And everyone, if you've been on the channel and you know where I like to buy, I buy off of support levels and especially the retest. And it almost becomes second nature if you've been on the channel for long enough on where I like my buy points. It becomes pretty apparent, I think, anyone who's paying attention. And that's usually a continuation higher. Come in through and look in. The U.S. government has looted the Strategic Petroleum Reserve to artificially lower oil prices ahead of midterm elections. Now at the lowest levels since 1985. Good thing there's no geopolitical hotspots that could threaten global energy supplies. Am I right? And I know someone asked what were the levels at. And if you were to kind of look across, it looks like it's about 450 million barrels left in the Strategic Petroleum Reserve, somewhere around that area. We are at the lowest SPR volume since 1985, straight off a cliff. So someone was asking, so 450 million barrels is what's left. Looking at this, it says the consumer discretionary sector is now worth 2.6 times the size of the energy sector, while the energy sector generates over 5 times more in free cash flow. And this is where I was talking about free cash flow and the value of the energy sector. And this is just a kind of a description or a way to describe how much more expensive consumer discretionary is in terms of value versus cash flow. And this money, in my opinion, is going to rotate into energy. Energy will be, I think, a very good investment over the next 5 to 10 years because of the free cash flow that these guys are going to have. And they're going to buy back shares. They're going to increase dividends. And it's going to be, I think, a really good spot to be in. And I'll be honest, guys, I don't know what the future holds in terms of energy. I don't know if we're going to be doing a lot more solar or if that's not going to work and fossil fuels will be the spot to be. So that's kind of where I'm looking, is the energy sector. And I think that's one of the best investment opportunities. This is a ratio chart, shows how extremely undervalued silver is right now. And on a lower time frame or longer time frame, it has broken out with silver's huge baby bull move back in June or July of 2020. What I notice is if you draw a line going across here, this is the booty bottom. It's just a gigantic booty. And it may take some time to work its way up and over. So it's one cheek here and then the other one's coming. But that's silver, and it could go up much higher in relationship to the S&P 500 versus back in the 1980 bull market. Concurrently, European natural gas, TTF, is up to $500 a barrel of oil equivalent. We were talking about that before. Look at this thing go vertical. That's also, I think, going to drag the Henry Hub higher as well, which is American natural gas. And as you can see, I purposely put this. Natural gas hit another decade high this morning. We're up 4.59%, 976. We're rocking and higher here for American natural gas. We see that base load reports numerous high-grade uranium intersects, including 0.55% U3O8 over 13.2 meters. More good information and news flow coming out of baseload. We've got the big picture, which is what we need to focus on. Don't get lost. Backtest of 200 weekly moving average, very normal for a long-term trend change. An arc support on URA, and there's your arc, and we're right on that arc support, ready to hopefully move higher at some point. I think that the overall markets have been dragging down uranium with it. It could continue to do that. It very well could. And we could see lower prices in uranium before a big, large move higher. It doesn't mean that the bull market is necessarily over. It just may mean that it's delayed a little bit longer than what we had thought. In the beginning of commodity bull markets, I always say it's a real tough hold because usually at the beginning, as these commodities start to move up, we see an inflationary impulse or move, which then puts most things into a decline. And usually the markets are very leveraged up. They've got a lot of margin in the markets. Lots of people need to deleverage that margin, that borrowed money. And in the beginning of that market, there's a lot of deleveraging going on in the stock market, which drags the entire market down. There's lots of volatility. So yeah, it's good to be long commodities, but they can be pushed and pulled in all directions in the beginning, and it's very volatile, and you don't know exactly when they will decouple and if they're going to get pulled down with the overall markets. And a lot of the times they do get pulled down with the overall markets, and timing it is really difficult. So be right, sit tight, buy pullbacks is kind of my mentality for a good long-term commodity bull market that's ahead of us. Here's Martin. He says, I spent a decade of my career specializing as an energy analyst visiting oil fields around the world, and I know just enough to be dangerous. The industry is so undercover now with generalists still thinking peak demand is around the corner. I agree with that. I don't think peak demand is here. I think that it's out a good long ways even. It could be 2040. And it's dangerous to have such underinvestment in oil and natural gas and some of these fossil fuels when the transition hasn't even proven itself to be successful or worthy to transition to. I'm mainly talking about electricity, and we don't have enough electric cars, and I don't know if we have the minerals to make these electric cars at the rates that we want to make them at. So it's going to be a very botched transition, I think, between fossil fuels and whatever is next. We'll say that. It says, good luck, Northern Europe this winter, the great winter of discontent. UK inflation to hit 18% on natural gas crisis. Now, the one thing I want to point out here is natural gas has a large impact on inflation. It is used to heat homes. It is used for electricity generation as a transition fuel. If natural gas continues to go higher, I think that's going to impact inflation, just like oil is. So these are the two kind of leaders which I think will drive inflation higher. We can see that natural gas in Europe, and I think even in America, is going to go higher than where we are today. And we can see earlier in this that they're both going on up, TTF and also American Henry Hub pricing. That's going to have an impact on inflation. And we're going to see, I think, continued inflation. Now, will it be at greater and greater rates? I don't think so at some point. It may be in the near term because the inflation is calculated off of your current reading versus the year ago reading. And a year ago, as we continue to push higher here, these rates of change are quite dramatic. So the base that we're going off of is moving up dramatically. And I don't know if we're going to keep moving up at that dramatic pace over time. We'll find out. But I think the inflation rates will slow at some point. Here is natural gas needs to finish strong today to hold above the line. And what I mean by that is I've got the Livermore accumulation cylinder. We're breaking out of this upper channel trend line here, and we want to hold above it if we want to break out to the upside. Otherwise, you'll see a wick at the top, much like these other wicks, where we come back down below the line and create a wick. A wick is just means it traded through that area and then came back down and closed below it. So if we want to launch in natural gas, it must close above the trend line. This is the daily, just to show you guys, we are breaking to the upside. We've got nice fat green candlesticks, not much down pressure. This is the wick at the top. So if we put a wick at the top and we close below, that means that there's still a lot of selling pressure up there. If we close strong today and end strong, it means that the sellers are losing the battle. So that's what we're looking for in natural gas on a closing today. And I'll talk about that at the commodities update. So I put up there, hold the line on natural gas. We got to hold the line above it. That's our goal. Obviously, Scott's saying, Andy, waking up this morning to natural gas breaking out. Boom. I posted Colin Campbell back in 2005 when we were hitting an oil crisis back then. Talks about the ramifications of peak oil against the credit in the system. Cheap energy backs our currency system. And guys, I'm just posting this, and you don't have to get scared or depressed over this stuff. I'm posting it just to get you guys information. And I'm looking at this from an investment perspective to protect myself from inflation and an energy crisis. So that's what I've got for today. If you guys like the content, definitely give me a thumbs up and subscribe to the channel. If you guys want to follow me on how to play this natural gas and energy crisis, the description link below is the website. My website goes over all of I think, the best companies that are out there to play this. There are smaller to mid-cap companies in oil and natural gas. I've got a whole bunch of uranium companies. Obviously, I've kind of teamed up with other individuals. I use my technical analysis. I look at the fractals and the DNA of the charts, and I come up with companies that I've diversified across. These, I think, have the most leverage to the move, but the most leverage also means they're the most volatile. So you're going to have to pick what you want. And if you guys have questions on how to approach, you can ask me and get my opinion on what might fit, what might fit the volatility that you're looking for. But again, they're just my opinion. It's not advice. I'm not a financial advisor. So if that interests you, definitely sign up for the Platinum membership in the description link below. You can see what my portfolio is. It's done very well. I got in at very good opportune times in 2020. I've accumulated along the way a bunch of companies, and I think they're doing quite well. All right, guys, we'll catch you next time. This is Finding Value.